Hi, everyone, and welcome to the Physician Guide to a Healthy Retirement. My name is Mark Zidey. I'm the Executive Director of WisMed Financial. With me here tonight is Elisa Allen, and she is the Medicare expert as part of the WisMed Assure team. The slides for today are available at wismedfinancial.org/retirement. And we're going to be talking about various financial topics. Personal finance is obviously personal, so those disclosures are meant to inform you that you may need to seek your own financial advice given your own personal situation. The agenda today, we're going to go through Medicare, long-term care, Social Security, income from investments, Roth conversions, and tax-efficient withdrawal strategies. So we're going to touch on the major key points for retirement. And to get us kicked off and started here, Alisa is going to start us off with Medicare.
Thank you, Mark. And thank you for joining us today. So, as Mark said, we've got a lot of topics to cover today. We're going to take a very high level look at Medicare, enrolling in Medicare, and then start touching on Social Security before I turn it back over to Mark. So, let's take a look at the basic building blocks of Medicare. This federal program is made up of two components to begin with, what we call original Medicare. It's made up of Medicare Part A, which is the hospital component of Medicare, and Medicare Part B, the medical component of Medicare. Medicare Part A, the hospital component, covers hospital stays, skilled nursing facility care, hospice care, and some home health care. There are co-pays, deductibles, and other out-of-pocket expenses involved with Medicare Part A. Medicare Part B is the medical component of Medicare. This will cover your office calls, labs, x-rays, and other outpatient services. With original Medicare, you're no longer in a network situation. You can go to any provider that accepts Medicare patients in the United States. So when you start your Medicare journey, which we'll touch on briefly, you're going to want to sign up for Medicare Part A and Part B when it's your time. And again, this is original Medicare. The next component of Medicare is Medicare Part D. This is the drug plan component of Medicare. Your outpatient drugs would be covered under Medicare Part B, or under D, excuse me. So when it is time for you to sign up for Medicare, you'll need to take care of your drug coverage. This might be through a prescription drug plan, which is administered by a private insurance company contracted with the federal government. Part D drug plans also provide extra help for people with lower incomes. And if you're an individual that does not require, you just don't have a lot of drugs that you take, in Wisconsin, there is a solution called Wisconsin Senior Care for you. This is actually initially set up for folks with lower incomes, but it does act as a placeholder for people who don't really need a drug plan, but need drug coverage to avoid paying a penalty down the road for not having a drug plan in place. Again, this is something that we can talk about and reach out, and we can give you more information on Medicare Part D. The last component of the federal Medicare plan or program is called Medicare Part C or Medicare Advantage plans. These are designed to replace original Medicare, and think of these as plans that are private Medicare insured by insurance carriers. So they are contracted through the federal government. They're required to provide the basic benefits that are covered under Medicare Part A and Part B, but their plans also include deductibles, co-pays, co-insurance or out-of-pocket co-insurance cost-sharing amounts. They do have provider networks that you need to participate in, and these plans do change every year. So every year you have an opportunity to recheck your plans, see if they're still participating, and see what changes have been put in place, and you can make a switch. These plans may also include Part D drug benefits. Those are also called MAPD plans. So when you're looking at the decision to make how you're going to go, you always have to start out with signing up for Medicare Part A and B when it's your time, and then decide, do I stay the course with original Medicare, figuring out my drug plan solution, and then sign up for a supplemental plan, also called a Medigap plan, to fill the gaps after original Medicare? Or do I go ahead and sign up for Medicare A and B and then go to that alternative Medicare coverage called Medicare Advantage? There's pros and cons to each way of choosing your coverage. We're definitely here to help you figure out the best solution. This is an individual decision, really tailored to your specific needs. So it's good to talk to somebody who knows the ins and outs of these programs to get the best fit for you. So enrolling in Medicare Part A and B, I want to take just a few minutes to go over that. So the biggest time that you hear about when enrolling in Medicare is when you're turning age 65. This is called your initial enrollment period. This is the 7 months, the 3 months prior, the month you turn age 65, and the 3 months after turning age 65. So for a lot of people that are retired, they're retiring at age 65, this is the time that you want to go ahead and sign up for Medicare A and B. Figure out if I'm going to go ahead and stay the course with original Medicare, sign up for a Medicare supplement, or transition to a Medicare Advantage plan. This is the time to make a choice if that's what you want to do. If you continue to work, you can delay signing up for Medicare, and a lot of times without a penalty. Because what you're going to find out is that there are some times if you don't sign up for Medicare, you may incur a lifelong penalty. But the federal government gives you an opportunity, especially for those that have continued to work or are covered under a spouse's plan, to sign up once that coverage ends. This is called a special enrollment period, and actually Medicare gives you 8 months after that event to sign up for Medicare Part A and B. Typically B is more of the crunch that you need to be concerned about. But again, we really encourage you to be proactive. Sign up when you're starting to plan on doing that change in your coverage, and so you have continuous coverage. They also provide for some other opportunities due to national disasters and such to sign up, but typically special enrollments are due to having coverage once your employment plan ends. When you're leaving an employer plan, there are some opportunities with COBRA and different ways to extend coverages with retiree plans and other type of plans. You really want to be sure you touch base with your HR people, the employee benefits people at the employer group to see how the plan benefits coordinate with Medicare. If you are a part of a smaller employer group under 20, Medicare may pay first versus the employer plan. Or if you retire and you're already Medicare eligible and take COBRA might not pay first. Medicare may. So you want to be sure you have a full understanding of who pays first and how your plan is going to coordinate with Medicare when you have big changes at the end of your career or your spouse's career. So definitely we're here to help you navigate those changes as you move forward. And finally, another time to sign up, if you missed the boat and you just didn't sign up when you should have, there's a general enrollment period that happens every January 1st to March 31st, where you can go ahead and sign up. Your coverage is effective the first of the month after you sign up. But in this situation, again, this is sort of the last resort when you didn't sign up when you should have. This is a situation where a lifelong penalty would apply. So again, always be proactive, reach out for more information to be sure how your situation is going to work to avoid those surprises down the road. Now, right now, when we're recording this is during the annual open enrollment period, which happens October 1st through December 7th. This is a time, and you're seeing a lot of ads on television, a lot of information is out and about where you can switch Medicare Advantage plans, you can switch drug plans, Medicare Part D plans, and you can also switch from original Medicare and back to Medicare Advantage and Medicare Advantage back to original Medicare. You can do a lot of switching right now for January 1st of next year. Please note if you have a Medicare supplement, or they also call it a Medigap plan, that type of free switching doesn't apply during annual open enrollment period. This is really more focused on Medicare Advantage plans and Medicare Part D plans. So if you definitely want more information, please reach out. We have a lot more information to share with you on this. This is a slide, again, as Mark said, this presentation's available. Mark will get into more of the costs of Medicare, especially with IRMA adjustments for folks that have higher earnings, may pay more for Medicare. So he'll go over that a little bit more in the presentation. But this is just showing you that the costs of Medicare in 2025, they usually go up every year. So 2026 will have a new set of costs. So another service that you want to think about is long-term care. Before I go quickly into enrolling in Medicare, long-term care is a type of service that helps cover supportive medical and non-medical services as you transition through life. This would be assisted living and medical and therapeutic care, like if you need to go into memory care, if you need to go into a skilled nursing facility because you can't handle your activities of daily living anymore. The room and board for those type of services is not covered by Medicare. Medicare will only cover those type of services if you've had a situation and you're not ready to go home. So in a long-term situation where you're just really never going to go home, you need that additional care. Those type of services, especially the room and board, would not be covered under Medicare. You would need additional insurance or an additional coverage to cover those type of expenses. And we've got on our team people who can help you with that. Please reach out if you'd like more information on long-term care coverage. So, and again, my contact information, I'm here to help you. But now I just want to run through a few slides, teeing this up for Mark to go into more on Social Security and retirement planning. So Social Security is the other part. Medicare was the health insurance program offered by the federal government. Social Security is part of income replacement offered by the federal government. It helps older Americans. It's not meant to be a total income replacement, but you've paid into it as a working person through your working life. It covers people who are retired, disabled, survivor of workers who have died, and dependents of beneficiaries. So this, I remember getting these through the years. Again, once a year, it's a report showing my lifetime earnings. We don't get these. They stopped in 2011. So if you have not gone to myssi.gov and signed up, you really should do that so you can see if your earnings have been accurately documented by the federal government, because your Social Security benefits are based on those reported earnings. And really the key when it comes to Social Security and benefits is, and I'll get into the next slide about your Social Security retirement age, which has changed over time. But if you push the button or decide to start collecting Social Security earlier, you'll get less benefit. You can start as early as age 62. And if you delay collecting Social Security, you can actually get an increase in benefits. Those benefits cap at age 70, and there's different calculators. Mark will go through those, and he'll give you some perspective on it. But I'd like to just show you the current chart shows right now at age if you're born after 1960, the Social Security full retirement age is age 67. So if you start Social Security after age 67, you'll have a bigger benefit or a larger benefit. If you decide to start Social Security before age 67, you'll have a lower benefit. And on that note, I'm going to go ahead and turn it over to Mark.
Thanks, Elisa. When we're talking about Social Security, one of the best things to do is to go to the ssa.gov website, log in, and run your own calculation there. What it'll do is it'll when you look at your initial Social Security benefits, one of the things that it assumes is that you continue to work up until those various ages, anywhere between age 62 and age 70, when you can start your Social Security benefits. So one thing I like to do is actually put in an average future annual salary on the SSA website of 0, because what that'll show you is the Social Security benefits that you've earned up to this point in time, even if you didn't work another day into the future here. The other thing about Social Security that I want people to be cautious of is the Social Security online calculators. I think a lot of them miss a really important point, and that's the effect of Social Security on net worth. Most of the online Social Security calculators simply look at what's your Social Security benefit, what's your assumed mortality age, and then if you're going to live long enough, it'll tell you wait until age 70, or if you're going to have a short life, start Social Security as early as you can. It's basically the way those calculators work. They completely ignore net worth, which I think is important here, because if you retire, let's say you retire at age 62, but you decide to delay taking your Social Security until age 70, you need some income to live on for those 8 years. And that income has got to come out of your nest egg. And so, on the one hand, you can wait until age 70 to claim Social Security income. That'll give you a higher guaranteed income after age 70. However, if you start Social Security earlier, it means that you can now preserve some of your nest egg and not have to spend it early on. So I think when you factor in the impact on net worth, it really does change the decision age of when to start Social Security. So let's talk more about income in retirement, and specifically income from investments. So we've got a few different guaranteed sources of income. Social Security obviously is one of those. If you're lucky enough to have a pension, that's a nice source of income. Immediate annuities, and some people just do a little bit of part-time work heading into retirement as well, which can help to support that lifestyle and those living expenses. We can also draw some income from bonds, from dividends from our stock investments, real estate distributions or dividends from that, master limited partnerships, etc. So that all comes from investments. And then we have a variable slash other category of capital gains. And this is really where stock market fluctuation comes into play here. And what we're looking at on this chart, the green bars represent the range of return for stocks at over different length time periods. So over a 1 year period, stocks can be anywhere from down 37% to up 52%. However, as the time period gets longer, the range of returns gets narrower. And so we don't want to necessarily rely on stocks for year one, year two, year three of retirement. We don't want to have some other assets that are available, because this just goes back to investing 101. Buy low, sell high. We don't want to be selling low with the stock portion of our portfolio. The blue bars in this graph, that's the bond market, and then the gray is a mix of stocks and bonds. So let's put together some income now, and how can we apply this to a real life here? So a lot of people will think of, well, we got needs and wants. You got to have some money to cover the needs. If we have some extra, maybe we can pay for some of our wants. And so capital gains might fall in that category. For example, if the stock market is up, there's no problem harvesting some of those capital gains and using that to cover some of those want expenses for the short term. The long term, we can rely on capital gains for some of the needs and the wants, because again, the longer the holding period of those investments, the more narrow the range of returns, and we basically eliminate that downside risk that we have over the short term with stocks. So capital gains can play an important role in both paying for needs and wants in your cash flow. The trick to this, because the stock market can be so variable, is knowing how much money that you can withdraw from your portfolio. Now, we're going to go above and beyond what's referred to as the 4% rule. And the 4% rule was a study that was done decades ago, and it basically said if I'm 65 years old today and I'm going to be retired for 30 years, age 95 mortality, how can I ensure that I never run out of money, even if I retire at the worst possible time in stock market history? And so a study was done and it looked at retiring for 30-year periods, rolling 30-year periods, and figuring out, well, if I retired in a good period of time, I could spend more than 4%. If I retired at the worst possible time and I limited my first year withdrawals to 4%, I could ensure that I don't run out of money. So we can go well beyond that though today by using something called guardrails. And this becomes really important when you also think about there is a the amount of money that somebody needs in retirement isn't constant. In fact, in many cases, what we see is something like this. So let's do a little bit of a case study here. So here's a married couple, and they're going to be retiring. They would like to have $8,000 a month to cover their baseline expenses, so some of those needs. But they also want to do some traveling. So 10,000 bucks a year in travel expenses for the early years of retirement, say the first 10 years. They also have a mortgage that they're still paying on for the next few years. And then they have about $2.47 million worth of assets. 600 of that is their home. The rest is some cash in the bank account, and they've got 1.825 million among their various investment accounts. And so for somebody like this, who's got some heavier income needs up front for travel, paying off that mortgage, and oh, by the way, this couple is also planning on delaying some of their Social Security. So they need to have some higher withdrawals from their portfolio early on. And so the 4% rule of that constant cash flow from a portfolio just doesn't make sense because of their varying income needs. So here's what we can do. Let's use guardrails in this instance. So using their $1.8 million portfolio, they can safely withdraw $11,800 per month to live on. Now, the guardrails come in here because as the market goes up or down, we can adjust that spending to make sure that this couple never runs out of money. So if their $1.8 million portfolio goes up a little bit to 1.9, they can actually increase their spending to 12.3. If that portfolio, on the other hand, goes down to 1.375, they've got to tighten up their belt a little bit. But notice it's a pretty modest tightening of the belt. It's only $500 going from 11.8 down to 11.3 of spending per month. And that'll be enough then to preserve their portfolio and ensure that they don't run out of money. And so here's how that works in the real world. And so this is actually looking at one of the worst possible times to retire as well. So somebody who retired right before the Great Recession of 2008, 2009. So the blue line on this graph represents the percentage of their portfolio that they're going to withdraw as we go through time here. And so it starts, close to 10%, and then you see these spikes, 10 years worth of spikes, that's the travel expense, 10,000 bucks coming out for travel. You notice that this income is also higher, and then the withdrawal rate drops. Well, two things are happening there. One is that the mortgage gets paid off, so we don't need the income to pay the mortgage bill anymore. And the second thing that happens is they started Social Security. And so now we don't need to rely on the portfolio for income as much because they can spend Social Security income instead. The lower graph represents the guardrails going through time. And so the green shaded area is one guardrail, the red shaded area is a second guardrail, and the blue line is the value of their portfolio. And so 2007 going into 2008, 2009 was a big dip in the market, but it wasn't quite enough to ever touch that lower guardrail. It just barely stayed above that lower guardrail, so they did not have to make any changes to their spending. Coming out of the Great Recession, we had a really good bull market, and the dashed vertical lines represent times when they could give themselves a raise during retirement because their portfolio grew faster than was expected. So they got a raise there, another raise here, 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 and here. Further, if we look at 2022, that was a down year for both stocks and bonds. And so you see that in this lower graph here, but it was also a period of high inflation. And so while the prior years, we had enough uh, withdrawals coming out to keep up with inflation, we did need to make one inflation adjustment, one additional inflation adjustment, which you see on the vertical dash blue line in the top chart here. And so the guardrails can be a great way to manage the size of your portfolio and right size your spending um, to make sure that you can pay for your needs, your wants, and not outlive your portfolio, but also utilize your portfolio to the spending that you want to. So let's move on to Roth conversions. This is another really, really powerful strategy that can help with retirement. So the green portions of this graph, this represents taxable income. And this is a real client case. They are age 55, and this is a married couple. One client is going to retire at around age 62. The other one's going to continue working until age 65. And so that's why you see the two little humps in the graph there as they head into retirement. In your mid 70s, you're going to have what are called required minimum distributions. And so all of the pre-tax or tax deferred retirement accounts, the IRS eventually wants to get their piece of the tax bill. And so starting in your mid 70s, you have to take some money out of those accounts, and then it becomes taxable income to you. And so it's very common that we see this valley shape with taxable income, where between retirement and your mid 70s, when RMDs start, required minimum distributions, that's the really an opportune time to pay some taxes because you're in a really low tax bracket during those years. And that's what the horizontal colored lines represent going across this graph. Those are the income tax brackets. And so one thing that we can do is we can take those tax deferred accounts and let's pay taxes during those low tax years, as signified by the blue on this graph. You got to pay taxes on those tax deferred retirement accounts anyway, so we might as well do it when we can do it at the lowest tax rate. In this case, it would give this couple a lifetime savings of about $743,000 just by managing their tax bill in this way. So we need to learn a little bit about how the tax code works. One way to think about this is that all of your income is like water in a pitcher or water in a bottle. We're going to first pour some of that water out into things like deductions. So it might be a 401k or an HSA account if you still have access to those, or at a minimum, the standard deduction or itemized deductions if you're able to itemize. Once that money comes out, now we're going to start to fill up the tax brackets as signified by the glasses here. The thing that people get that misinterpret when it comes to taxes is they think, oh shoot, I made too much money this year. I'm in a new tax bracket. Now all of my money is taxed at that higher tax rate. And that's just simply not how it works. As you pour money into the 10%, 12%, 22% tax bracket and so forth, it's the money that falls into that glass or that bracket that is taxed at that rate. So for somebody that has some higher income and they hit the 32% bracket, it's only those last few dollars that are taxed at 32%. All of the income up to that point is still being taxed at those lower rates. And so here's what those brackets are. So for 2025, a couple married filing joint, the first 23,850 of taxable income, they're going to pay 10% on that, going up to 96,950, 12% on that portion, 96,951 up to 206, 22% and so forth. Now that's on ordinary income. The we also have those standard deductions. So for a married couple this year, 31.5, if you're over age 65, you get an additional $1,600 per person on top of that standard deduction. Plus, new this year is this enhanced senior deduction of additional $6,000 per taxpayer that's at least age 65 by the end of the year. Now, there's something called that I refer to as collateral tax damage. And this is where we have to be a little bit more careful when we're doing Roth conversions. Because as we increase our income by doing conversions, and again, what a conversion is, we're taking money that's in a tax deferred account, transferring it from that tax-deferred retirement account like an IRA or 401k. We're transferring it from there into a Roth IRA. And every dollar that we transfer becomes taxable income for that tax year. And so the higher your income, now we start to lose some other benefits. So for example, the higher your income, the more you pay in Medicare premiums. It's called IRMA. It stands for Income Related Monthly Adjustment Amount. Basically, the more income you have, the more you pay in Medicare premiums. We start to lose some of that enhanced senior deduction. That gets phased out. Capital gains tax gets phased in. We're going to look at that here. Net investment income, the SALT deduction, if you have really high income, you start to get phased out of that over $500,000. And Social Security benefits. So when we were looking at Social Security, if you don't have any other income, chances are your Social Security is non-taxable. But the more other income that you have, the more of your Social Security that becomes taxable income to you. So we need to be cognizant of this collateral tax damage that happens when we do these Roth conversions. So here are some of those limits. So Social Security, again, up to 85% of your Social Security can be taxable. And that's really getting, it's a function of having some other income typically. Here are the Medicare IRMA surcharges. So if your Medicare, excuse me, if your adjusted gross income goes over $212,000, if you're married, or $106,000 if you're single, now you start to pay this additional Medicare Part B surcharge and Part D surcharge. Now that's per person per month. So for a married couple, we're talking about a few $1,000s a year of additional premiums because you have higher income. So it's another form of a tax basically. Let's look at long-term capital gains for a moment here. This is pretty interesting. If your income is under 96,700 and you have some capital gains, your capital gain tax rate is 0%. No tax whatsoever from at least from the feds. Once it's over 96.7, now you're in the 15% tax rate. So as you have more ordinary income, that's going to push your capital gain income into those, perhaps from the 0% bracket into the 15% bracket. And then for folks that have over $200,000 or $250,000 of total income, that net investment income tax may kick in for the portion of your investment income that's over that 250 mark. So let's really apply this to a case study here. So here we have a married couple, both are over age 65. They're both receiving Social Security. They are receiving their investment dividends. Instead of reinvesting them, they're being received as cash. And they also cashed in about $100,000 worth of investments, of which 20,000 of that is capital gains, long-term capital gains that they need to pay some taxes on. So for this couple, they've got total cash flow of $173,000. And so that's a combination of $20,000 of total dividends, plus the 53,000 from Social Security. So now we're up to 73, plus the 100,000 of investments that they cashed in. So that's where we're getting the 173 from. However, check this out. Their adjusted gross income is only $65,000. So even though they got 173,000 hit their checking account, only 65 is showing up on their tax return. Well, why is that? Well, it's right here. So those dividends, those show up 20,000. The taxable portion of their Social Security income, 125, that shows up on their tax return. And then not the full $100,000 of investments that they cashed in, but the portion, that $20,000 of the capital gains of that 100,000, that's what shows up. So 65,000 of AGI. Now, because they're over age 65, they get both a standard deduction plus that enhanced senior deduction. So we're going to knock 46,700 off of their tax bill, leaving with taxable income of only 18,000 bucks. Now, of that $18,000, that came from long-term capital gains. At this level, their capital gain tax rate is 0%. So in this scenario, these people pay zero federal income taxes, and even though they have $173,000 worth of cash flow. So starting there, these folks would be a great candidate to consider Roth conversion. So let's start to incrementally figure out how large of a Roth conversion that they should do. And so that's what we're looking at here. We're starting with that $65,000 of adjusted gross income, and we're adding income from Roth conversions in $1,000 increments. So the first few thousand bucks, no big deal. It doesn't create any taxes. And then we get into the 10% income tax bracket. But notice here this purple. What's happening with this purple is that now, because they have additional income from those Roth conversions, now more of their Social Security is becoming taxable as well. So even though the income tax rate is 10%, they have a dollar of they if they have a dollar more of income from the Roth conversion, another 85 cents of Social Security is being becoming taxable income. So a dollar Roth conversion is really a dollar 85 that's being taxed. Or to say it differently, it's equivalent to about an 18.5% tax rate at this level. We get to a point where all of the maximum amount of their Social Security is taxable. And so additional conversions above that point are actually at a reduced tax rate, at least for a while here, until we get to about $60,000 or so, at which point this red kicks in. And what's happening here is we have enough ordinary income from those Roth conversions that now we're pushing those capital gains instead of being taxed at 0%, now they're being taxed at 15%. So similar to that Social Security, now we've got income that wasn't being taxed before is now becoming taxable as our Roth conversion pushes our taxable income up. The green on here is now the phase out of that enhanced Social Security benefit. So that's $6,000 per person, $12,000 for the couple. They start to lose that tax deduction as they have higher income. So when you lose a deduction, that means you have more taxable income. So in effect, that's another form of taxation here. So the reality is if they did about a $75,000 Roth conversion, a portion of that Roth conversion would actually be equivalent to a 30.2% tax rate, which is a pretty high tax rate for most folks. The other thing you see on this graph is the vertical dashed lines. This is where those Medicare IRMA surcharges kick in. And so, as we look at doing a Roth conversion, we want to find perhaps the sweet spot on this graph. Maybe we're okay with doing, going through the Social Security taxation and we're comfortable with that. But perhaps we don't want to jump up into this area of the tax bracket where now we're effectively at a 30% tax rate for that portion of income. So this might be a sweet spot right here, right around $55,000, $60,000, just below where that tax rate ramps up. If you have a large enough tax deferred account, you may say, gosh, I just have too much taxes to pay. I just need to convert more. Well, another sweet spot might be just before that Medicare threshold or the next Medicare threshold. So there's a few different sweet spots on this graph that you might want to target depending on how large tax deferred accounts you have, as well as what your tolerance is for paying some taxes each year. And so let's talk about how we can now be efficient with those withdrawals in retirement. So conversions are one part of it, but we also need to get some income out of our investment accounts as well. And people really have three different types of income. We've got tax deferred income. That's all those pre-tax retirement accounts. We've got taxable accounts or just non-retirement accounts. And then we've got tax-free income from anything with Roth in the title. Roth IRAs, Roth 401k, et cetera. And so with those three buckets of money, let's figure out the sequence and priority of where should we pull some money from first in order to be tax efficient. Generally, it makes sense to first take money out of the taxable account from your dividends and interest. You're paying taxes on it each year anyway. So rather than reinvesting those dividends and interest, let's turn off the reinvestment, have those dividends and interest paid in cash and distributed into your checking account. And then you can spend those. Next, we're going to look at what kind of a tax target are we aiming for? Are we trying to fill up a tax bracket, or where are we trying to get to with the taxes? And so we might take some money out of those tax deferred accounts, get up towards whatever tax bracket we're targeting, and or liquidating some shares that have some unrealized capital gains, again, up to a point that we're comfortable in recognizing capital gains. If that if we've already satisfied the income there and we still have room before we get to our tax target, the third thing would be to do some of those Roth conversions. Let's fill up the rest of that. Um, let's fill up the rest of the tax bracket in the form of those Roth conversions. If we haven't hit, if we've already hit our tax target and we still need more income, then we can perhaps go to the Roth IRAs last, because that money comes out tax free. And so with that, I hope this has been helpful. Again, if you do have questions, please reach out to myself or Lisa. You can download these slides at wismedfinancial.org/retirement. And again, thank you for attending. Take care, everyone. Bye-bye.